would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome. As we kick off a brand new week, right here on Real Estate Realities with the Rebel Broker. My name is Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California. Member of the National Association of Realtors. But please, don't hold that against me. As always, the very best way to get in contact with me is going to be to head over to therebelbroker.com. From there, you can click on Contact the Rebel Broker, and you can send me a message directly. Send along any ideas, suggestions, observations, or questions that you might have. If you prefer to email me directly, just send those to therebel@therebelbroker.com. Also, while you're at the website, why not scroll up to the top and get in the bucket to potentially win a $50 Amazon gift card on November 1st. All you have to do is fill out the demographic survey. Again, that's the button at the very top of therebelbroker.com that's titled, Take the Survey to Support the Show. Just use the same email address both times you're asked, and you will be entered into the drawing for that $50 Amazon gift card. Now, we already handed one out on October 1st. We're going to do it again on the first show that happens in November. So feel free to join in and get your opportunity to win that $50 gift card. Anything else? Is there any housekeeping stuff? I don't think there is. I think that's kind of it. The only other thing I'd probably want to mention here is that if you would like to join the Rebel Underground, you can text the word Rebel Broker to 44222. That's the word Rebel Broker to 44222. And basically that just gets you access to stuff. There's a variety of new ways that I want to try to hand out information or get good stuff into your hands. And those are basically the folks who are going to see that kind of thing. So any free content that helps you figure more things out or helps you track things relating to real estate, or sort of a cheat sheet for different real estate tasks. We're also to find out a little bit more, going maybe a little bit deeper on certain stories, or maybe cover some topics that we just don't cover on the show. Those are the folks who are going to get in on that kind of stuff. So feel free to join in there by texting the word Rebel Broker to 44222. Okay, so let's get to it. And just as a side note, I'm coming down with whatever plague is currently running through my community. So we'll see how far I make it. I had a great weekend. I hope you did too. I spent it primarily helping my two youngest sons to build their own computers. So that's kind of cool. And they had a great time doing it, and they have not managed to pull themselves away from the things since we finished them. I want to talk about rents, though. That's the big topic for today's show. And predicting them. Not just talking about where we are now, but in addition to kind of chatting about where this growth is going to be happening, I also want to share with you a tool that you're going to find associated with the article that I'm referring to today. This comes to us from the good folks at Zillow, and they're covering an article here that's actually pretty interesting in terms of rental rates. So I thought we could just jump in and take advantage of what they're sharing. Their big bullet points here at the top of this are rents across the nation are forecasted to appreciate 1.7% over the next year. So that's supposed to be the average across the nation. Of course, for those of you who are actually investing, that's a pretty useless number, right? You're not investing in the average across the nation. You're investing in specific communities. That's one reason why I like this article so much, because if you do go and you check out the tool that's at the end, you can put in the city that you're interested in and get specifics there on what the projections are for rents. Can you imagine a better tool for jumping through some of the hoops we've talked about before? If you want to do a good analysis, if you want to figure out whether or not you think it makes sense to purchase in a certain environment or in a certain metro or whatever, having a tool like this where you've got folks who've been tracking the rent rates and where they think they're going to go can absolutely be an invaluable tool for you in helping you make the best decision possible. Another bullet point from this particular story, rapidly growing markets adding lots of jobs, including Seattle, San Francisco, and San Jose, are among the metros predicted to have the fastest growing rents. So that's obviously right here in my backyard. San Francisco's further north than I normally do any business in. But San Jose is sort of my backyard. I'm in the Morgan Hill area, which is just south of San Jose. But we're sort of a bedroom community for San Jose. And the last, what is it? I think I've had a couple of listings in San Jose over the last few months, a townhouse, a condo. So I'm active in that area. And rents there are just crazy. And they're projected to continue to be crazy. Now, we've already talked about some of these areas like San Francisco and San Jose, and right now, you'd have to be banking on increases, I think, for you to get into positive cash flow. Prices right now are so high. Now, the only time I think you'll be able to squeeze this kind of deal out, where you're going to be able to get positive cash flow at the time of purchase, is really in these next couple of months in Santa Clara County. I don't think there's a high probability of that. I think if you have any hope of accomplishing that, here, we're in that time zone when it's really going to happen for you. I'm always searching for those kinds of properties, and I tell you, it's really a difficult one to manage. So that's one reason why I think lists like this are so good, because it can help you spot those places where barriers to entry in terms of price just aren't anywhere near what they are for Silicon Valley and these high visibility areas like San Francisco and San Jose. So you can go in, figure out what areas are going to see decent growth over the next year, and then cross match that with communities that we've talked about in the past that have low barriers to entry. And we have covered tons of them. Go back and check out any of the past shows we've done just over the last week. I think we did 2 shows last week that had references to lists of properties where we made sure and looked at what the barrier to entry was, what the cost to get into those markets was. Fort Wayne, Indiana was one where we actually got into detail and looked at how much it would cost to get into some of these. In fact, let's just for grins, let's just jump in here and see if Fort Wayne is in here. Cool. So there's Fort Wayne, and it does the metro, and then it lets you look at all of the sub areas. And we've got, these are all sub areas of the metro area for Fort Wayne. Bluffton, 2.7% growth. I pick them. Churubusco, I don't know, 4.4%. Columbia City, 5.7%. Fort Wayne, 2%. Harlan, negative 2%. Hoagland, negative 0.3%. Huntertown, 1.6% increase. Larwill, 1.4% increase. Leo Cedarville, 2.6% increase. Markle, 4.9%. Monroeville, negative 2.5%. New Haven, 3.8%. Ossian, 3.3%. South Whitley, 1.4%. And Woodburn, 3.3% increases. So this is a great list. This is something you're going to want to look at as you're considering purchasing in these different areas if you're doing it from a distance. So clearly, I'd want to go for some place that's got that 4% or better projected increase, which would leave us with areas like Churubusco, Columbia City, Markle, and possibly New Haven, which is currently sitting at 3.8. But this is what I'm getting at. You can pick the metro area, and then you can drill down to all these various smaller areas to figure out what makes the most sense for you from an investment standpoint. So keep that in mind, and make sure to go to this link if you want to take advantage of this tool. And I'll have the link in the show notes for today's show. So make sure to take advantage of that. According to this article, also, rents in Seattle and Portland are expected to have the fastest rent appreciation over the next year at 7.2% and 6% growth, respectively. Now, some of those areas represent less of a problem in terms of getting in there and buying some property. But again, some of your best deals are going to come from places where the barrier to entry is much lower, but you're still seeing some decent percentage increases. And, everyone gives me this argument. Well, you know what, though? You're starting from lower numbers, right? The rents there are going to be lower. Well, if you're doing your acquisition prices right and you've got enough money where you could potentially jump into, now I get it, right? It's about comparing two marketplaces. If you've got the money to make a purchase in San Francisco or San Jose and the math works, great. But I would argue that you'd be better off using that same amount of money buying in one of these other areas and having multiple properties where that's going to beat out the growth that's expected in place like San Francisco and San Jose. You need to go where you're able to leverage off of it the greatest. And my argument would be that while we are expecting to see increases in Seattle, San Francisco, and San Jose, I'm not so sure that's the biggest bang for your buck in terms of the amount of money projected to benefit over the next year. Let's see. Annual growth in median rents nationwide has slowed considerably from last summer's breakneck pace. So another takeaway from this article is while we're seeing increases, it's slower than it was the year before. We're not seeing increases at the rate that we saw the previous year. So what the translation of that is, that's a slowdown. We're starting to see these prices increase at a much lower rate. So that's something I think you need to mentally prepare for. If you're someone who wants to reap potential growth in rent, or you have to, if you're someone who's going to make that calculated risk and you're going to buy where you've got a very narrow margin of positive cash flow or none. I mean, I've had some investors that have jumped into some markets where they don't get positive cash flow right out of the chute and are counting on the market to catch up over some period of time. These are things that you need to be aware of. You need to take into account the idea that this is a slowing train, and it may be a situation where it does not get to where you need it to be for you to have positive cash flow. So giving yourself better margins on these things at this point, whenever you're in a marketplace where you're starting to see things slow, I think giving yourself more elbow room is actually more important. So that's why my eye would be drawn more towards some of these less known communities that have got some of the diversity and some of the utility in terms of having a lot of different things going on in those communities that are likely to help it weather a tough time. And then the next question I get is, well, how do you know if it's a community that can weather a tough time? Well, most of these communities have been around a lot longer than 10 years. So how did it weather things the last time we had a big downturn in real estate? Did they tend to just blow right through? Were there big reductions? What was it? Just sort of calibrate yourself to that as nearly a worst case scenario and figure out a way that you would potentially survive an issue of similar proportions. Say, it could be anywhere from a 25 to 50% reduction in the value of the property. But also remember, if you're renting, what does that do to rental rates? Because back then, you didn't see a reduction in rental rates. Rental rates went up. So that's likely an insulator for you as well in terms of planning forward what might happen in a downturn. Okay. U.S. rents are expected to grow 1.7% through August 2017 to a Zillow rent index of 1,429 per month. Among the 35 largest metro markets covered by Zillow, rents are expected to grow the fastest over the next year. In Seattle, 7.2% increase. Portland, 6% increase. Denver, 5.9%. Cincinnati, 5.2%. And San Francisco, 4.9%. So given just what I know about the San Francisco market and what I've read about Seattle and Portland, my eye would be drawn more towards places like Cincinnati and Denver, where I'm going to get that nice big increase, but where I may have the potential opportunity to get into some of these at a lower price point than some of these other high-profile locations. Now, that may not be true in Denver. If you'll remember, we had a listener who reached out who has been saying that in terms of Denver, purchasing has been very tough, but apartment rentals has been pretty easy. A lot of incentives apparently for apartment rentals. But since we're seeing an expected 5.9% increase in rents, I'm guessing that that's driven mostly by single-family residential. And similar rather than apartment growth specifically. Now, we're going to take a quick break for a minute, but when we come back, we're going to talk about what some of the actual dollar cost basis is for some of these areas. The numbers will blow you away, so don't go anywhere. We'll be right back after this.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right. Aside from hosting this show, I am also the owner, broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Welcome back, everyone. We've just been talking about the rental market, what the expected growth is, and in addition to that, talking about this great new tool that is embedded in this article from Zillow that is going to help you drill down into local communities within these different metro areas to see if you can't get calibrated to how much growth in rent you can expect over the next year. Now, this article is written to sort of span the August to August timeframe, so August of 2016 to August of 2017. We've already talked a little bit about what these numbers kind of mean, where your eyes should be drawn. It's again, a lot of this is simply math, where you just need to figure out what makes the most sense for you. But let's sort of talk about some real dollar values here. Now, let's talk about a little bit of ground truth first. One thing that I'm finding interesting is the lack of rental units. There is not a ton of choice in terms of folks wanting to go out and rent property. I know that in my area, in Morgan Hill, for a home of my square footage with my number of bedrooms, I could rent this property for over $4,000 a month, which kind of blows my mind. We'd be talking probably somewhere in the neighborhood of $4,200 to $4,300. If I wanted to be aggressive and really elbow out the competition, when I go and I look out on what's available for rent, there is no competition. I couldn't find a 4-bedroom home for rent in Morgan Hill. So where do you go with that? And I know what 4-bedroom houses have been renting for previously as they've come and gone off the market. I'm very confident that if I were to put this home on the market for rental, I'd probably have it rented within 30 days at that price, which is absolutely nuts. Now, on a pure dollar and cents basis, the two Bay Area metro markets of San Jose and San Francisco, respectively, remain the most expensive large rental markets in the country by far. Renters in and around San Jose should currently spend $3,517 per month on rent. So the typical rental is a 3-bedroom. So I'm sure that's kind of, if you're taking quote unquote what the average is, that's about right. And from what I've learned from talking to folks working with buyers who are currently paying rent, that's the range. It's a little bit cheaper down here in Morgan Hill when you can find one. But again, there's just not a whole lot of inventory even of rentals. Let's see. In the San Francisco area, medium rent runs $3,406 per month, and I'm willing to bet that is a number that refers to far smaller residences than what we're talking about in the San Jose area. Los Angeles was the next priciest rental metro in August at $2,593 per month. Looking ahead a year, these multi-county areas will remain among the nation's priciest. If rents rise as expected by the end of next summer, renters considering the typical apartment in San Francisco should expect to budget $3,573 per month. In San Jose and LA, median rents are expected to rise to $3,677 and $2,718 per month, respectively. So, and while we're talking about acquisition costs and figuring out how to get into these marketplaces, that kind of growth is nuts and obviously very attractive. But given what properties are going for in terms of price right now, as I mentioned earlier in the show, you're going to be hard pressed. But what I'm going to do is suggest you stick to your guns on this stuff. If you're someone who really, really wants in some of these more popular areas in Los Angeles or Silicon Valley or San Francisco, if these are areas where you really want to jump in, keep looking. You never can tell what's going to happen. I honestly believe that over the next 2 to 3 months are going to be the most likely time that you're going to be able to find something that's going to be positive cash flow. Now, I have noticed a slowdown in the markets here in Morgan Hill. I'm way more plugged in with the markets in Morgan Hill, and this tends to be slightly less frantic than the actual Silicon Valley area. But simply by virtue of the fact that there's no inventory, we're still sort of maintaining this slight frenzy in terms of the marketplace. So things are still tending to sell relatively quickly, but it is taking longer than earlier in the year. And it's taking longer than it was a year ago at this time, specifically for the properties that are most in demand, 3 bedrooms, 2 bath homes. Okay. Now, again, one of the great things about this article is the Zillow Rent Forecast tool that you can use to drill down to smaller areas. For instance, as they mentioned in the 3-county Seattle metro, rental growth over the next year is expected to rise as quickly as 18.4% and 13.6% in the highly desirable communities of Shoreline and Medina. At the other end of the spectrum, median rents in the smaller, lower-moving communities of DuPont and Lake Bay are expected to grow just 0.4% and 1.9% respectively through next August. Which brings us to another point. When you hear a number that says we're expecting 5% growth in metro area X, don't just assume that means wherever you're going to buy. I got a great message from a listener when we were talking about how lucrative military towns can be in terms of sort of serving the folks who are serving on a military base and those who are living off base, and how important it was to understand crime in those areas. And while that's absolutely true, it's also important to understand this kind of dynamic where there are areas that are simply more and less desirable. And these are going to be indicators. This chart of data is going to be a great way for you to be able to focus a little bit more closely on the areas that are in higher demand, because that's going to represent higher rents for you. Let's see here. You know what? And just for grins, let's go ahead and look at San Jose and see what they project, since that was something really in the high end there in terms of what we're expecting in terms of rental. Let's go ahead and take a look at it and see what the sub-communities are projected to be in terms of growth. There we go, San Jose. And we'll just look at all of the various cities here. So what we're seeing here is it's projected to go to 1,429 on average. If we do and it's just been a straight up thing here. I'm sorry, it went to Seattle here. Let me, I don't recognize any of these cities. Where the heck is this? Let's see. So San Jose. All right. Hollister's even on this list. Some very interesting, and Morgan Hill is on here too. Wow. Some of these numbers are mind-blowing. Hollister is expected to grow 9.8%. For those of you who are longtime listeners to the show, you know that I have done business in Hollister a couple of times. I am not a fan of Hollister. Hollister is an extra 30 to 40 minutes away from San Jose, and that's where most people commute to. I've had to sell 2 properties in Hollister, both of them for folks who worked in San Jose, and it was ridiculously hard hit by the downturn. But they're expecting a 9.8% increase in rentals. Now, Hollister is also one of those places where the last person I helped buy in Hollister, which was the beginning of this year, was ridiculous. The amount of money being paid for properties in Hollister blew my mind, and I found it particularly annoying. But it's also a community that tends to perform less than Morgan Hill. So the fact that they're expecting to see a 9.8% increase in Hollister is kind of a mind blower. But then you've also got areas, and that would be one where I would say you could probably absolutely make a purchase in Hollister where you could make the math work, where you could purchase and then potentially be positive cash flow. Now, there's other areas where that's just not going to happen for you, most likely. Los Altos, which is, there's Los Altos Hills, which is sort of the Beverly Hills of Northern California, and Los Altos, which would, I guess, be Bel Air. Los Gatos is another one. Milpitas, Montecito, Morgan Hill, according to this, is going to see a 7.6% increase in rents over the next year. San Martin, which is the town just south of me, is expected to see 4.4%. Gilroy is expected to see 6.5%. There's absolutely properties. You're not going to find amazing deals in places like Gilroy, but I could absolutely see myself being able to swing a positive cash flow deal in Gilroy. So make sure to consult this. Figure out the areas you're looking in, whatever metro area you're nearest to. Hollister is a good hour and a half with good traffic away from San Jose. So your first instinct may be to think, well, you know what, the community I live in is just too far away from whatever metro area it is that you're in. But given how far Hollister is, for Hollister to be considered part of the San Jose metro area, man, all bets are off. You could be way outside of a particular area and still be potentially included on this list. So make sure to check that out, figure out what kind of an effect it's going to have on you, and see where you should be drawing your gaze. Now, remember, these numbers are just projections. It'll be interesting to see how accurate they end up being a year from now. And it also assumes that nothing horrible happens over the next year. I think they're making some assumptions here that may or may not follow some of the things we've talked about. And I know we've talked about some potentially really bad stuff, but assuming everything sort of stays in the same realm, even the same level of bad, I could see where these numbers absolutely play out. And you know what? The truth is, we could sit back and criticize and get more and more concerned. But I think the reality of the situation is that you're just going to suffer the paralysis of analysis if you really want to just really go too crazy on this stuff. But also, I think that in order to handle the concerns that we've expressed here on the show, and I think they're very valid concerns, I think there's a wide range of crazy stuff that can happen over the next year that could likely do things to the market. So you need to ask yourself a couple of questions. One, do you think that the bad things that are about to happen, if they're going to happen, are going to negatively affect your ability to get rent? Will you be able to charge the same, more, or less for rent after the event occurs? Given what we've talked about, I honestly think that probably rents would stay either flat or would go up. If we see a huge devaluing of the dollar, well, that increases rents, right? And if you've got yourself a fixed mortgage, that doesn't mean the amount you pay on your mortgage goes up. It means your prices stay the same or your costs stay the same. It just means that you can now potentially charge more to draw out the same amount of value. In other words, instead of thinking of it as dollars, if you think of it as loaves of bread, if someone paid you 1,000 loaves of bread per month to rent your house, you'd always expect that 1,000 loaves of bread. And if you're instead of getting those loaves of bread, you're getting pieces of paper that you can trade for 1,000 loaves of bread. If suddenly you can only get 900 loaves of bread, well, then you're going to change the medium of exchange so you can still get that 1,000 loaves of bread, right? Does that make sense? I always go down this route of trying to come up with these comparisons, and I hope they work. But that's the point, right? It's one of those deals where it's a value thing. However, if things go the way they may go, you probably won't want to do that. What you'll find is that your tenants are in the same boat. They still need bread and milk and everything else too. So everything for them has increased in real dollar costs without a corresponding increase in income. So what you may end up doing is pushing really good renters out of your house because you're making it impossible for them to continue to rent. In a scenario like that, I would actually probably freeze my rental amount as long as I'm covering my costs and making a reasonable return on my house, which I should have been, right? If we're doing our math right at the beginning, we should have been making a reasonable return on our property. And if raising your rent is going to cost you a great renter, my suggestion is to not raise your rent. And it, of course, depends on how much we're talking here. But by and large, a very good, reliable renter is worth their weight in gold. So consider that when you're doing this math too. Anyway, so once again, thank you all for making this show part of your daily routine. I realize how valuable your time is, and I hope that in exchange you've gotten some valuable information. Please do check out the link that I'm going to include in today's show's show notes so that you can get access to this cool rental forecast tool. In fact, you can even download it. There's a little download link here as part of this chart. So this could be data you could download locally, which would be pretty darn awesome. So anyway, thanks again for listening, everybody. I'll talk to y'all next time.